So, a famous study asked corporate executives, what is your preferred method for making capital budgeting decisions? And they were allowed to list more than one. 75% of these corporate executives listed net present value, which is somewhat comforting. It would have been better if it would have been 100%, but 75% is still okay, especially considering that the survey included some small, very small firms. However, the net present value was not the most favored measure. That honor belonged to the internal rate of return. 76% of the executives used the internal rate of return. So what is the internal rate of return? That's what I'm going to explain in this set of lectures. So you'll see what it is and why perhaps it is so popular. One thing that you'll see about the internal rate of return that I believe makes it so popular is that it is a single number. Given the cash flows of an investment, most of the time, but not all of the time, you can boil down all of these cash flows and the initial cost to one number, the internal rate of return. Whereas the net present value gives you a number, yes, but it depends on your assumption of the discount rate. This may be why people like the internal rate of return. However, there are some very significant costs with using the internal rate of return. After these lectures, you will be able to weigh these costs against this benefit of having only one number and decide which is your preferred method. The internal rate of return which everybody calls the IRR, is the discount rate that makes the net present value, namely NPV, equal to 0. So the IRR rule says, except if the IRR on the project is greater than the discount rate, otherwise reject. Let's contrast this with the net present value rule using an example. So we've got a really simple project. The cost is $100. So our cash flow at time 0 is negative 100. And in 1 year, it will pay off 110. So the cash flow at time 1 is $110. So the NPV, that's easy to calculate. It's minus 100 plus 110 over 1 plus R. So the IRR solves the following equation. 0 equals minus 100 plus 110 over 1 plus R. So the IRR is the discount rate R that makes NPV equal to 0. So if we go ahead and solve this equation, we see that R is equal to 110 over 100 minus 1, or 10%. So let's contrast the IRR rule and the NPV rule in this example. So we need to set a value for the discount rate. Let's say the discount rate is 8%. So substituting this into the formula for the net present value of our investment, we get NPV equals minus 100 plus 110. Well, now we have divided by 1 plus R, so it's 1.08. And that is equal to 1.85 greater than 0. So NPV rule says accept. What about the IRR rule? Well, remember, the IRR is equal to 10%. That's the discount rate that makes the NPV equal to 0. So notice R is less than the IRR. The IRR says except if the IRR is greater than R, which is the case in here. So the IRR rule says except. So in other words, they agree. And that's not just because of the values that we picked. So let's consider what the net present value looks like as a function of R. So this is R on the x-axis and NPV on the y-axis. And these graphs are actually kind of helpful in understanding the relation between NPV and IRR. So notice that NPV is a decreasing function in R. If R were to equal 0, which would be a rather low R, we would know that the NPV would equal 10. Then it's decreasing. It's not linear, actually. It crosses 0 at the IRR, which in this case is equal to 0.10. But what I want you to realize from this graph is that if the NPV is greater than 0, for this case, namely when the NPV is given by this function, the IRR is above the discount rate. So if we think about this part of the graph over here, what's true? Well, what's true is that NPV is greater than 0. What's also true is that R is less than the IRR. So the IRR is greater than R. If we look at this part of the graph, then the opposite is true, right? NPV is less than 0, and IRR lies below R. For this project, we can conclude IRR and NPV rules agree. Now that's for this project. But it's actually kind of general reasoning. Any time where you have a project where the NPV as a function of R looks like this, something like this, then the IRR and the NPV rules will agree by the same reasoning as I just told you. So this point here is the IRR. So if NPV looks like this, namely is characterized by this graph, IRR and NPV rules agree. Now, when might it look like that graph? When does NPV look like this? Namely, what we're really using here is that NPV is a decreasing function of R. Well, this is true if you have a project where first you invest money and then you get money out. So that's true for what we call a normal investing project. So it's true if NPV equals C0 plus C1 over 1 plus R plus C2 over 1 plus R squared plus ... and C0 is less than 0, C1, C2, etc. These are all greater than 0. Then we're fine. You can see that in that case, the NPV is going to be a decreasing function of R. Now, that's not always going to be the case. So next, we're going to discuss the cases where the NPV rule and the IRR rule do not agree. So when might NPV and IRR not agree? Let's consider this example. So we have the first cash flow at time 0 is $100. The cash flow at time 1 is negative $130. NPV of this project is 100 plus negative 130 over 1 plus R. The IRR, namely the R that makes NPV equal to 0, is equal to 30%, right? Because if we say 0 equals 100 minus 130 over 1 plus R, that implies that R is equal to 130 over 100 minus 1. So now suppose that the discount rate is 10%. So the IRR rule reasons as follows. The IRR, which is equal to 30%, is bigger than 10%. So we should accept the project. NPV, let's see. NPV is equal to 100 plus negative 130 over, now for 1 plus R, we're going to plug in 1 plus 0.10, so 1.10. That's equal to minus $18.20, less than 0. So the NPV rule says reject the project. So here, the IRR rule and the NPV rule disagree. They come to precisely opposite conclusions. What's going on? Notice what the NPV looks like as a function of R. So NPV equals 100 plus negative 130 over 1 plus R. When R is 0, NPV is negative 130. It looks something like this. It crosses the x-axis at the IRR, which is 0.30. %10 is somewhere over here. So notice that indeed 10% is less than 30%. So the IRR rule applied strictly says accept, but the NPV is negative. This is minus 18, more or less. So that's mathematically what's going on. Instead of having NPV a decreasing function of R, it's an increasing function of R. Intuitively, what's going on? So notice in this project, you start by getting an inflow of $100, and then you pay $130. This is a financing project. not an investing project. In this project, you are in effect borrowing $100 at an interest rate of 30%. For a financing project, you want a low rate of return, right? Because you are the one borrowing the money. But the IRR rule doesn't know that. The IRR rule just calculates a rate of return. So if you really like the IRR rule, you need to reverse the IRR rule to get it to work for a financing project. If you reverse the IRR rule, meaning you accept if R is less, if R is greater than the IRR, see, even I getting confused here, then IRR and NPV rules agree. Though, I would say, why fuss with this? In this case, perhaps it's just best to stay away from the IRR rule. Now, I think it's pretty intuitive that you wouldn't want to go around applying the IRR rule, the by the books IRR rule, IRR being greater than R, in a financing project. There's a few more subtle things that could go wrong. The first is there is no guarantee that you will find a single IRR. So let's consider the following. At time 0, you have a cash flow of minus 100. At time 1, you have a cash flow of 230. At time 2, you have a cash flow of minus 132. So you can think about this as partially an investing project and partially a financing project. There's a little bit of investing, say between 0 and 1, and a little bit of financing between 1 and 2. So in this case, if you graph the NPV as a function of R, what does it look like? Unfortunately, it looks something like that. The NPV, which equals minus 100 plus 230 over 1 plus R plus negative 132 over 1 plus R squared, crosses the x-axis twice, once at 0.10 and once at 0.20. So in this example, there's simply no way to apply the IRR rule. If you try, you might make a mistake depending on where the R is relative to these two numbers. So really the correct region is when R is between 0.10 and 0.20. So in this case, we have multiple IRRs. There's multiple solutions to this equation. So you can't use the IRR rule. So that's one thing that can go wrong. Another is that you might not find any solution at all. So suppose at time 0 you have 100, then at time 1 you have minus 300, at time 2 you have 250. So again, this is a mix between an investing and financing project. This is kind of an interesting project because it turns out that for this project, NPV is greater than 0 for any R greater than or equal to 0. So there happens to be no IRR, and again, you can't apply the IRR rule. So to summarize, When you are trying to accept or reject a project, you can apply the IRR rule when the project is an investing project. It starts out with negative cash flows and the cash flows become positive. Then the IRR rule and the NPV rule agree. But if the cash flows switch in sign, or if they start out positive and become negative, then the IRR rule can give some pretty strange answers. So in the previous clip, we talked about the IRR rule when we have an accept or reject decision. And the conclusion we came to is that as long as we have an investing project, the IRR rule and the NPV rule agree. So that's fine, and that may give people who really like to compute IRRs some comfort because perhaps most of the time we are faced with investing projects. However, in practice, often the way the NPV rule and the IRR rule are used is not as an accept or reject decision, but to compare two different projects. And here we run into a host of other problems with the IRR. Let me just give you an example to show you what I'm talking about. So let's say we have the following two projects. Project A and B. We'll make a chart. So Project A starts with cash flow of negative 100, so the cost of Project A is 100. And then the payoff is 400. Project B starts with a cost of 250 and then a payoff of 650. So suppose that our discount rate is 10%. The NPV in each case we can compute. For Project A, it's 264. For Project B, it's 341. We can also compute the IRR. So for example, for Project A, IRRA is equal to 400 over 100 minus 1, which equals 300. That's a pretty good IRR. 300%. For B, we can do a similar calculation to show that the IRR is 160%. So these are both really good projects. In terms of accept or reject, the NPV rule and the IRR rule agree. Both projects should be accepted. But what if you can only do one of the two projects? You'd like to do both, but you only can do one. Maybe you only currently have the staff to do one. Maybe you only have the financing to do one for whatever reason. You can only do one project. Maybe they compete with each other. Which one do you pick? Do you pick the one with the greater rate of return? Or do you pick the one with the greater NPV? Well, which one will increase the value of the company by more? The answer is clearly B. Project B will increase the value of the company by 341, whereas Project A will increase the value of the company by 264. So we're comparing 341 and 264. 341 is bigger than 264, so we should choose B. But what about the fact that B has this lower IRR? Well, it doesn't matter because B can be done at a larger scale. To summarize, based on the last example, we saw that IRRA is bigger than IRR B. IRR A being 300%, IRR B being 160%. But NPV B is bigger than NPV A. NPV B being 341, NPV A being 264. How is it possible that these two can disagree? In this case, B is operated at a larger scale. The problem with a rate of return measure like the IRR is it doesn't tell you about scale. And when we're talking about increasing the value of a company, you care about the scale because it's the eventual dollars that you ultimately care about. So scale matters, and you should choose the project with the highest NPV. If you could scale up project A, that would clearly be the best, but you can't always do that. Now we're going to consider a different problem with IRR, one that has to do with timing rather than scale. So we have two projects, D and E. They cost the same, let's say $100. So they operate on the same scale. At time one, project D pays $100, but project E pays $10. Then at time two, project D pays $10, and project E pays $10. And at time three, project D pays $10, but project E pays $120. Which of these projects is better? Well, that's going to depend on the discount rate. You can see that these projects differ in the timing of their cash flows. If we show the NPV of D and E on a plot, so NPVE looks something like this. This is NPVE. And notice that when R is 0, by the way, the NPV of E is equal to 40. The NPV of D looks something like this. I'm exaggerating a bit, but you get the idea. So when R is 0, the NPV of D is 20. So the IRR of E is about 13%. The IRR of D is higher, it's 16%. Note that IRR D is greater than IRR E. Does that mean that we should choose D? Not necessarily. Suppose your discount rate is 10%. So if R equals 10%, then the NPV of D is actually lower than the NPV of E. What's going on here? So NPV of D is going to be less sensitive to the discount rate than the NPV of E, because for the NPV of D, you get your money back sooner. Notice that this is a flatter line. E has a steeper line. The question is, do you care if you get your money back sooner? Well, all else equal, of course it's better to get your money back sooner because of the time value of money. But for Project E, you get much more money in general than for Project D. So it really matters whether your discount rate is low or high. If your discount rate is less than the point at which these two cross, then Project E is preferred. Notice that this is very closely related to something that was discussed earlier, namely the yield to maturity on a coupon bond. So remember that in our coupon bond discussion, we said that the yield to maturity is a flawed yardstick because to actually receive the yield to maturity as your return, you need to reinvest the coupons. Well, the IRR is a similar concept to yield to maturity. In fact, it is exactly the same as yield to maturity if you define the project as purchase a bond. If the project is purchase a bond, then the IRR equals the yield to maturity. The price equals the present value of the payments, so the NPV of purchasing the bond is 0. So Project D would clearly be better than Project E if you could invest that wonderful $100 you got at time 1 at the rate of return of 16%, the IRR for D. But there's no reason to think you necessarily could. So that's the danger here of thinking about IRR as a measure of return for these two projects. You can't necessarily reinvest. You don't necessarily have a new Project D coming along at time 1. Another way to think about this is Project E is being unfairly penalized by being a long-term project. So if discount rates are 16%, yeah, this 120 way out here, that looks pretty bad. But if discount rates are only 10%, then you don't care. You're willing to wait. So this is actually, I think, a very relevant problem to a lot of investors. So if you talk to venture capital investors, they often use a kind of IRR rule where they will say, well, we're looking for IRRs that are bigger than 16%. And the idea seems to be that they have an investment that has a 16% IRR, and so they're looking for investments with better IRRs. That rule penalizes long-term investments. And unless the actual discount rate in the economy is 16%, which it's not, you can actually make more money by choosing projects that have a lower IRR but increase value by more because those payoffs are weighted more to the future. So that's something to think about. This is a tricky case, but one that I think we see all the time. It's a little counterintuitive, but it illustrates that rates of return, when we apply them to investment decisions, real investment decisions, aren't necessarily the way to go.